Piers Hillier is CIO Liverpool Victoria Asset Management, where he oversees £8.5 billion across all asset classes globally. He joins me in the studio now. Piers, good to see you. Before we get to the banks, we were just talking about your investment in tech. We've been speaking a great deal about Apple and Steve Jobs' resignation this morning. You do have a fund in the US, but you don't invest in Apple.
Yeah, well, it doesn't pay a dividend, and our approach to investing has really focused on income generation, dividend growth potential. I think if Apple started paying a dividend, it would certainly come onto our radar screen. Great business. He's a strategic vision, and obviously market's concerned about that. I think we've been known that he's been ill for some time, and he's worked closely with the team. They've put succession planning in, so yes, it's always a bit nervous when you see the final announcement come, but he is in the chairman's chair and will help to drive that forward. I think we'll see what more comes from there.
Yeah, and you do invest in IBM and Intel. Do you think that there will be any impact on their share prices? They might reap some benefit from this movement in Apple. I mean, we're seeing already shares in Apple falling in after-hours trade. I mean, there's only so much we can read into that anyway, but the sense that maybe investors perhaps a little bit skittish at this news.
Yeah, a little bit. For us, I don't think there's a massive connect. It's a unique story to Apple.
So let's talk about banks then, because you're saying that the sell-off that we've seen in European banks isn't justified, and it seems as though there is a bit of a debate going on about this right now. Some people saying, well, the banks are undercapitalised and they do need an injection from, say, the Eurozone bailout fund. Other people saying, well, actually their balance sheets are very strong and they're fine. So who's right?
Well, I think that's it. I mean, in the very, very short term, it's about sentiment, it's about fear, and essentially what you've had is sovereign risk cascading down to banks, people looking at banks' exposure to sovereign debt and saying, oh, we're concerned about them. I think, we saw some good numbers out of Commerzbank 10 days ago. We've seen decent numbers out of Credit Agricole this morning. Credit Agricole's giving you the first indication of what Greece looks like from them. And yes, they say they're going to need some top-up capital there. But I think broadly speaking, the bank's results have been better than people have been going for. So yes, we can see fear and volatility has been there, and I suppose we've been using that opportunity to go from sort of underweight to overweight in the banking sector. I think we also have seen a lot of insurance companies hit hard, so we've been topping up in that area, particularly like Allianz in that market. Stora brand actually is one we like in the Scandi market, which has been hit hard. But I mean, for us, the thing that's really changed in this move has not been as much financials, it's been the cyclicals. We've seen a lot of input price pressure concerns, and that's not just been in industrial cyclicals, it's also been in the consumer part of the market. Disappointing numbers from Ahold this morning. We saw a profit warning from Heineken. So some of the consumer goods stocks struggling to pass on input price. And I suppose that's really what's feared. It's been the fear in this last month is, are we seeing sort of just a soft slowdown, or is it double dip, sort of recession? I think we're in the first camp rather than the second, but what you are seeing, certainly for some corporates, is there has been margin pressure. So for us, we look at strong business franchises, the ability to control margin and be able to pass on input price inflation to the end consumer as the stronger business models. And that's really, I suppose, the theme at present has been more about a mid-cap sell-off in sort of the cyclical part of the market as much as the pressure in financials.
So you are actually increasing your exposure to banks and insurance companies. I'm just wondering, are you concerned at all about their exposure to sovereign debt? Many analysts saying we haven't seen the last of it, there are further write-downs to come, and then a lack of loan growth on top of that.
Yeah, there probably are more write-downs to come. I don't necessarily disagree with that. A question, look at where we are from a valuation point of view today.
Good buying opportunity.
The UK is slightly different to Europe. So, for example, in the UK banking space, we don't have significant exposure. We essentially only own Standard Chartered, but actually we own the Lloyd's ECN rather than the equity in our equity funds, because you've got a 13% yield on the ECN at this point in time. We think that's pretty good. Lloyd's, big backing from the UK government, unlikely to run into major financial problems here, and we think a 13% yield is a pretty attractive thing to pick up at this point in time. Sadly, if you wanted to buy it as a personal investor, it's £50,000 unit sizes, so a bit more difficult. On the continent, I think it's slightly different. We've seen a lot of rights issues on the continental European banks already, and we see more of those to come. So that's the real differential, I suppose, between the UK and Europe. And
it's interesting, you're underweight in commodities, aren't you? And I just wanted to get your thoughts actually on what we've been seeing in the price of gold at the moment, because, well, I mean, remarkable sort of meteoric rise, and now we're seeing it coming back a bit.
Yeah. I mean, it is still up on the week. I think you need to remind yourselves. I know it's come down 10% in 2 days. It had gone stratospheric. and so you'd naturally expect a healthy sort of pullback in it. I think we're sort of structurally surprised at how strong gold is. And I think, we talk about Italy and the concerns of sovereign fears. Italy is the 4th largest holder of gold in the world. It owns 2.7 thousand tonnes. That's $165 billion worth. Perhaps the Italian central bank might think about letting some go here and reducing some of the pressure. I think those are the kind of things where you see an asset inflation as it is in gold. I'm slightly surprised you haven't seen some of the central banks using that and saying, well, fine, okay, we'll provide liquidity in the gold market if you want it at those prices, and that relieves some of the pressure in the short term. So an interesting scenario in that one. Not sure the Italian central bank has done anything about it yet, but we strongly push them to do it at this point in time.
And Piers, I've got to ask you about Jackson Hole. All eyes on that. Do you think they'll fire the golden bullet that some bullish people want?
I'm afraid you're likely to be disappointed if that's what you're betting on today. I think they will. I mean, Bernanke's said consistently through this, we will be accommodative. I'm afraid you're not going to get the golden bullet this weekend.
Great. Thank you so much, Piers Hillier. Great to talk to you, CIO of Liverpool Victoria Asset Management.